Welcome back, everybody, to another episode of What Does It Mean? The podcast. I'm Lindsey Bell, and I am here today with my pal, Bob Lang. Chris Versace's got the week off, lucky guy. But I think you're in good hands with the two of us, right, Bob? Have you been watching the Olympics?
Oh, yes, Lindsey, it's been fantastic. The United States team has won some nice medals. The gymnastics men's team, which they were atrocious on Saturday, came back and won a bronze yesterday. It's been great, and it's only been 5 days so far, with another week and a half left to go. So I'm really looking forward to some of the track and field events next week. Lindsey, it's a little history here. The last time the Olympics were on the West Coast, it was in Los Angeles, the Summer Games, and I was about 17 years old, and I was there. I went to the track and field events, saw guys like Carl Lewis and Jackie Joyner Kersee and some of his others. What was funny is that I didn't have a car then, Lindsey, and I rode my bike across miles and miles of traffic in Los Angeles to get to the Coliseum. I was so obsessed with going to watch the Olympic Games. So, and as you know, baby, the Olympics are going to be coming back to Los Angeles in 4 years. So hopefully I'll be out there again, but not riding my bike.
I know. Hopefully you have a car, you have an Uber driver or a self-driving car, right?
That's right. That's right. So,
Well,
so Lindsey, what have you been watching? What sticks out to you, and what's your favorite events out there?
So I've been really into the gymnastics. I'm totally into that. I'm totally into the swimming. So I've been all over that. The women's gymnastics. I told you guys last week I watched the Simone Biles special on Netflix, and it was absolutely fantastic. But I was surprised when the women's gymnasts came out. They did their first round of beams. They just seemed rattled and out of it. I don't know if I'm the only one that picked up on that. I was like on Twitter looking to see if other people were feeling that same way. But anyway, they're just fantastic. And I think they're, especially Simone's level of difficulty is above and beyond. But the one sport that always blows my mind, Bob, that I just can't wrap my head around why it would be enjoyable to anyone is water polo. And I actually came across this story that did you hear about Flavor Flav's partnership with the captain?
Yes, I did. It's amazing, right? I mean, it's kind of silly and ridiculous, but I mean, it if it works, I mean. But
yeah, well, it's just like what you see too with a lot of the women sports and the athletes here in the U.S. in general. The story for women is they don't get paid what the men do, and yet even some of the sports like women's soccer, they still get the viewership, but they don't have the sponsorship. They don't have the money from the brands. And I think in general, when you look at the Olympic athletes, at least from the U.S., I think partnership with sponsors for the athletes, it's actually been down since 2012 in London and 2016 in Rio. So to see a partnership like this it brings fun and excitement back to the sport, right? And I was reading the story about it. It's just really random that it's Megan Steffen. She's the captain of the water polo team, and her agent encouraged her to tweet out asking for sponsorship. Actually, I can't remember if it was a tweet or an Instagram post. And he told, I guess, his friend that is a talent manager for Flavor Flav about the connection. And the two of them decided to get Flavor Flav and Megan Steffens together. And the rest is, I guess, history. And he's like their biggest hype man of the sport. So it's just been fun to watch, right?
What'd be really funny, Lindsey, is if we saw all these players wearing large clocks on their necks, right? I mean, following
the
Flavor.
water.
In the water, right?
But it's just the point is, it's the Olympics is also the big money making thing too for some of these brands, or at least it's a place for them to get viewership and build up their brand awareness and marketing. So there's money to be spent there.
Absolutely, money to be spent, money to be made. Also, what I've been watching, Lindsey. Now, when I was back in school, I played volleyball a lot, so love volleyball. I've been watching the beach volleyball competitions, but more recently, the last few years, Lindsey, I've been into tennis. I've been playing a lot of tennis here. So, and been really obsessed with watching some of the tennis on Tennis Channel, and maybe, here and there picking up some tips. So the tennis matches that have been going on the last, couple of days have been great. There's been a swarm of young players coming on the tour, on the professional tour, like people, like Alcaraz and Sinner and some of these more popular players. But what I found interesting the last few days is some of the older players, and I say older because they're in their late 30s. I'm still way older than they are, but guys like Rafael Nadal, Novak Djokovic, Stan Wawrinka, and even Andy Murray, who recently announced he's going to retire this year. These guys all won matches in the first round, so it's great to see and good to the competition, and even age isn't really much of a difference when it comes to competing at this level.
Yes, no, I'm with you. I'm always like, oh, they're in their mid-20s, or even, you're right, like the 30-year-olds are the old ones. But they're still so young. They have so much life ahead of them. The other thing, too, is a lot of these folks, getting back to the sponsorship point, is they actually have full-time jobs. And that they showed, I forget the swimmer that won bronze in the U.S. He's a project manager, and they showed like a video clip of him. But they do have day jobs. And I think the Wall Street Journal made a really good point over the weekend, too, about the Olympics being, what did they call it? They said it was, I don't have it here in front of me. They said it was, can the Olympics save the summer? And I think the point that they were making is that it's a nice reprieve from, for us, the volatility that we've been seeing in the market, right? Or maybe it's the election banter and what's going on there. So it just gives you something to move away from. And I think like they put it the best way at the end of that article, was just like the Olympic Games, they're a genuine athletic competition and an uplifting realization that every day you get to see the best day of someone else's life. Like, how cool is that? Like, it's a positive.
Oh, and just to wrap that up, in the men's gymnastics, they had this fellow who's actually from my area near Boston, came out, and he only was in one position. Steve, can't remember, it was Nostrus. I can't pronounce his last name. Anyway, so he only is in one event. It's the pommel horse, and he finished up, and he nailed it off the pommel horse, and he enabled the men's team to win the bronze, and they were ecstatic that they got the bronze because they were awful in the preliminaries on Saturday, but they managed to get it. So this guy, I mean, it just, as you said, just made his life so great. They compared him to Clark Kent, Superman, because he sits there and wears glasses, and then all of a sudden he takes his glasses off and gets on the pommel horse. It's just a lovely story, and like you said, it puts an imprint on these guys and gals' lives that allows them to show some pride in their country, and for one moment they get to be the star.
Yeah, and it's so great for all the hard work they put in. Well, why don't we wrap this section up? I think that's going to be a great segue, though, into what we want to talk about this week with increased volatility in the markets, right? The Olympics really has been that relief, perhaps, from the daily volatility in the market. We're going to get into that. We're going to get into the consumer, what's going on with them, the job market, GDP in our economic zone. And we'll talk about what all this means for investing in the markets and your money right after this short break. All right, let's get back into it, Bob. Let's talk about the volatility of the market. It's really picked up since about mid-July. You look at the VIX, for example, and we were pretty calm market if you're just looking at the VIX as an indicator, right? We were under or around 12 since mid-May through mid-July. In the last 2 weeks, that's all changed. So here we are, volatility picking up. And I know that you particularly, one of the things that caught your eyes was last Thursday. It was, we started the day in the red, then we bumped up to the green in a really big way, ended the day in the red. What are you looking at when you see the volatility like this on a single day that we just haven't been used to it?
Well, there's a strong correlation, Lindsey, between uncertainty and implied volatility, right? And what happens is that when there's a lot of uncertainty in the markets, or elsewhere, whether it's geopolitical concerns or macro concerns, or even if there are battles going on that we really don't know how those are going to end, we see rises in implied volatility. And why is that? It's because people get nervous and people get worried and scared that things aren't going to fall in place for them. So when we see rises in volatility, it doesn't necessarily mean markets are going to go down. It simply means that the ranges are expanding, right? So when we had a good long period of time earlier this year when the VIX was 12, 13%, maybe 14%, but it was just really cemented in that low level for a while. We would have large rallies up, but we wouldn't have any pullbacks. And then any pullbacks that we had were really short and shallow. As you referenced last week, we had a big rise in volatility up towards 19%. Now, put that in terms of where we were just a couple of weeks prior to that, when we were at 12%. So if you do the math from 12 to 19, that's better than a 50% rise in volatility in just a very short period of time. And the reason for that is because a lot of the uncertainties that are out there, let's talk about Fed policy, let's talk about the election, let's talk about some of the battles and the wars that are going on around the world. Lots and lots more of uncertainty, and it continues to change and evolve each and every day and week. So that is a problem for traders and for investors, because there's a lot less reliability and a lot more worry about the uncertainty going on. And so until that is released. Now, when we have news releases, Lindsey, that come out like the jobs report or a Fed report or an earnings report, we see some of that volatility recede and go down. It makes sense, right? Because once that's past us, all we have to do is think about the future. Implied volatility is all about looking at the future, not necessarily what's happening now. But when that implied volatility starts to come down, people get a little bit more comfortable and they start adding stock. So that is kind of a long-winded answer as to why we have implied volatility, but it's simply put that the fact that we have larger ranges.
A really important point that you just made is that the swift move higher, it wasn't a gradual increase, and we know that the VIX usually doesn't move just gradually. But when it does make those spikes up, that's when you got to wake up and pay attention, right? But I will still say, that being said, is that even it's come back down to 16 or what, that's not usually a red indicator that even that level, the historical average, I think if I recall correctly, is like 19. So anything below that, usually market participants are comfortable with. But again, it's the move and the sharpness and quickness of that move that I think will be the most important. So, we talked a little bit about it last week, but, the election can add volatility because of the uncertainty around it. You usually do see volatility pick up going into the election. But do you think that there's a chance, given that we know potentially both candidates? I know Kamala Harris hasn't been completely locked in yet. Do you think that this time could be different in that volatility may smooth out at least in the next couple months?
Well, Lindsey, the VIX term structure, as talked about a couple of weeks ago, is pricing out higher volatility out into the future. It's pricing out higher volatility in October because the market is expecting some turmoil or chaos or something to happen. Now, the last couple of times we had elections in 2020 and 2016, the same thing happened, but volatility pulled back because everything seemed to fall into place, right? Even though in 2020 we had the controversy and so forth, and everything would happen in the beginning of January of 2021, it wasn't a smooth transition, but it was a transition. Now, I think the problem this time around is there's a lot of worry and a lot of new things that are coming out and developing about this election, and will a change in power actually happen smoothly, right? The markets like smooth. They like reliability, and they like things that they can count on. When there's a lot of uncertainty going on right there, it creates a lot of chaos. And that chaos tends to make people hit the sell button. And when they hit the sell button all at once, where the market's going to go. So probably for the wrong reasons. Maybe it doesn't mean anything about fundamentals or earnings or that sort of valuation. But remember something, that the emotions in the short term tend to drive market performance much more than they do in the long term. I'm with you on the long term, Lindsey, with earnings and valuation and that sort of thing in the economy and looking at those metrics. But as far as the short term is concerned, it's all about emotions and feelings and how people are reacting to different things happening.
Speaking of emotions and feelings, we did get PCE inflation last week, which it seems like it gave investors at least what they wanted, right? It calmed the markets. It seemed to kind of help stop the slide that we had seen in the S&P 500 over the last, week or so. And so we saw a bump up in stocks at the end of last week, especially a revitalization of the rotation trade that we've seen. And so I think I went back and I looked at what sectors were doing well versus what sectors weren't doing well since July 16th, which is really when the pullback started, which never quite made official pullback definition of 5% to 9.9%, but we got close at 4.7%, and we're starting to move a little higher in a choppy way now. But the sectors that led the downside were tech, communication services, consumer discretionary, and industrials. And of course, tech earnings, questions about the future there, and it really kind of sort of led that volatility in those sectors. But on the upside, you had utilities, consumer staples, real estate, healthcare. Even financials were hanging in there. Some of that was like better earnings, but some of it is like a trade to prepare for getting defensive, to get prepared, or getting prepared for rate cuts, just depending on what side you're on. And, the narrative is that a rebalancing is happening. It's really just we're getting out of tech because they've had this massive run. Valuations have gotten stretched. It's time to take profits in those sectors and move our money into sectors that maybe have underperformed, the value versus growth conversation too. You can also see it in the equal weight versus the market cap weight S&P 500 indexes. But is it really just we're rebalancing and we're so smart that we're locking in profits? Or is it that people are starting to get a little defensive? And, I wonder that myself. Where do you stand?
Well, I think that people are getting wise to the fact that it's not only 7 stocks that can carry the market any longer, right? We had the Mag 7, and they were driving the action in the markets for a good part of 2024. And now we're seeing a little bit of separation between those names. And look, it's not just 7, it's probably 15, right? Let's call it 15 out of 500. That's still a very, very small percentage of names that are driving the action. But now we see what's called the RSP, or the equal weighted S&P 500. Now, what is that versus the regular S&P? Simply put, it's an equal weighted index that every stock in the S&P 500 gets one vote, right? They get the Apple, the most valuable company in the world, gets one vote. Uber, which is a far cry of, it's a fraction of the valuation of Apple, gets the same one vote. It's like the Senate, Lindsey. It's that everybody gets one vote, and regardless of what your population is. Well, the equal weight
good analogy.
Thank you very much. It works the same exact way. Right now, the S&P 500, on the other hand, is a valuation index, and the highest valuation names in the S&P 500 get the highest weight. So that's why when they call the Mag 7, which is Apple, Amazon, Alphabet, Tesla, NVIDIA, and so forth, and a couple other names, those are a large portion. I can't remember the percentage, Lindsey. Maybe you know, but it was like 26% of the S&P 500 is driven by those 7 names. Does that sound about right?
That's the market cap weighting. Yeah, that sounds about right. It's 30. It's actually 32% right now.
Yeah, 32%. So, and that's even after these stocks have corrected over the past few weeks. So, but now what we're seeing here, Lindsey, the past few weeks is a separation. We're seeing the S&P 500 underperforming the RSP, or the equal weighted, and that's interesting because when the equal weighted is doing much better, it seems it's the breadth of the market is much stronger and a lot more participation, which is what you talked about, not just from technology but healthcare and energy and utilities and so forth, and home builders, materials, industrials. A lot of these other companies that were overlooked earlier this year are now starting to perform better alongside each other, even as the other names like a Microsoft are actually performing poorly. So I think it's important to watch this. I think that we've had months and months of underperformance by the RSP, and now they've finally turned the tables, Lindsey, and started to move back up.
Well, Matt, I'll just quickly say that turning of the tables is a positive sign. It indicates that, more, like you said it, more sectors, more stocks are participating in the bull market. So it's a healthy sign that it could have some legs. But I think I land on where it sounds like you might be landing too, is we're sort of in this no man's land where we don't really exactly know what it means, because Is the rotation happening because we want to get defensive because the economy is slowing, or is it just we want to take advantage of these value-oriented sectors that are actually going to do really well if the economy does take off? So I think that, like, from my perspective, we're in a wait and see mode. The good news is that more stocks participating is a positive. Why don't you tie it in a nice little bow for us? What does it all mean, this volatility and rotation that we're seeing?
As far as the rotation's concerned, as you said, it's very healthy. It's good to see a broad amount of sectors participating to the upside. It means that these sectors are attracting funds and money. They aren't just places to hide out. Back in the 1970s, they referred to something called the Nifty 50, and there was a group of stocks that were attracting so much money, but none of the other stocks in the index were getting any funds at all. So it was just a matter of time before these 50 some odd stocks got so overvalued that eventually somebody had to pull the pin out of that balloon and it would implode. Now, I'm not saying that that's the case with these Mag 7 stocks, but certainly you can make an argument for the past several months. A lot of money has been flowing to those names, Lindsey, and people were just becoming very complacent when it came to putting money to work. And they would say, well, look, you know what? It's just got to be NVIDIA. That's all I have to put my money into. I can just put my money in there, fall asleep, and then wake up in a couple of years, and I'll probably double or triple my money. And that's really been the attitude, frankly. And it's really the wrong approach to, as far as I'm concerned. I think you as well too, for investing. It's there's no hard work down there. There's nothing really to do other than just to follow the lead of anybody out there who seems to be pretty smart. But as it relates to volatility, yeah, you know what? Increases in volatility bring out great opportunities for us, right? Because when volatility starts to rise, people get nervous and they start selling stocks for the wrong reason. And when stocks get knocked down, to a certain extent, we tend to find opportunities right there. So between the equal weighted moving strongly versus the S&P 500, and then the higher volatility, meaning that some stocks are coming down, I think it creates a great opportunity, excellent opportunity to start picking up stocks.
I think that's a great bottom line. Volatility and rotation means opportunity. So I'll take it. I think you're absolutely right. But now the question is, moving on to our next topic, let's talk about the consumer, right? Is there opportunity in consumer land? We're not going to get the, pure play retailer earnings for a couple more weeks, like mid-August. August 15th is Walmart earnings. Target's the following week, and we'll get some of the other department stores and other retailers. But we have heard from some consumer-directed companies from an earnings perspective. The most recently is McDonald's. We kind of laughed about and joked about their extension of their $5 meal deal, which is great. But they reported earnings and it was bad. They missed across the board, Bob. It wasn't just same-store sales missed, which is kind of what you were expecting given that announcement the prior week. But revenues missed, earnings missed, and not just slightly. They really missed. Same-store sales for the whole company overall were negative for the first time since 2020. We saw a down 1%. In the US, that was down 0.7%. And it was driven by a drop in foot traffic. And basically what I heard on the earnings call was that this company is a company that is acknowledging that their meals, their product is becoming less affordable with, by extending their promotions, by actually saying on the call that the gap between in the value that they offer has shrunk them versus their competitors. So they know that their pricing is the problem. A couple other things I pulled on the earnings call was, the CEO said, we have an opportunity to improve our value execution. And they also mentioned that over the last several years that they were able to sustain the inflationary pressure, the inflationary costs that they've dealt with by raising prices from 20 to 40%. 20 to 40%, which overall inflation, I think, is up. I think CPI is up 20%, something like that, since 2019. I don't have the exact number in front of me. But so the numbers make sense. But when you think about that on an overall holistic basis, what you were paying for your Big Mac just 3 or 4 years ago versus what you're paying today, that's for the consumer. It's no wonder they're pulling back. And I'm going to say it again, and I've been saying it for a year now, but I really truly believe we are living in a real life experiment of the price elasticity demand. And these companies are finally they're starting to feel the pain. And so they know that the price point is the problem. You even saw Chipotle, which is and I know you probably have thoughts on this, Chipotle, a completely different animal versus McDonald's. And, they had a good quarter, but you know what, Bob? They said their sales growth are cooling, and that was reflected in their outlook. Domino's Pizza also, they gave a tepid outlook on the full year. So you could say maybe it's grocery prices are coming down faster than prices of eating out, and that's so the consumer is taking advantage of that. But I think it also goes to show, if we look at other industries, Sherwin-Williams, they've talked about the macro environment being softer for longer than they anticipate. Polaris, which does ATVs, their inventory is building. The consumer is watching what they're spending. We see inflation on goods coming down nicely, but inflation on services has remained elevated and is still up like 4% year over year consistently every single month. And so the consumer is being stretched, and they're being forced to make a decision. Where am I going to spend my money? Bob, my whole point here is it's not just the low-end consumer, which, by the way, we brush off as like, oh, it's the low-end consumer. They always struggle, but they're the ones that got the highest wage increases over the last several years. But that still wasn't enough to offset these price increases. And so I just think that it's what we're starting to see is this is creeping into the middle class. And that is something in an election year you need to start to worry about, but not just an election year, from an economic perspective in general. So I think consumers are making choices with their wallet, and I think it's more than the low-end consumer. I think and we could talk about the jobs report, I think it's bleeding into the middle income. Is there anything that's standing out to you about the consumer, or any data points that you've been really keeping your eye on with the consumer?
Yeah, I think that McDonald's worries are valid, but then, if I look at the stock, Lindsey, it's down 20, but prior to yesterday, it was down 20% for the year. So you have to wonder, is, some of that bad news was already baked into the price of the stock. And I think that's certainly
good point.
Really valid there. And then also some of these other companies had some rich valuations, much like Chipotle. And while they did have good earnings, there were some nicks and bruises on their earnings report that people really took issue with, and that stock went up after hours and it dropped down the following day, and then for a couple more days after that. So certainly the consumer, I agree with you, kind of slowing down. And I really love your thesis about the elasticity in real time, because when do you often get that opportunity to watch prices move in real time here? I mean, I don't know. Usually it's some sort of a rear view mirror look on what happened. But this is, like you said, it's a great experiment going on here, and it's really fun to watch, to see how these companies adjust in real time to what's happening in the future, and whether they can get their forecasts about the economy and the consumer and about growth correct. Look, I mean, you talk about high-end brands, Lindsey. I mean, are there two other brands that are so great, but the stocks have just been clobbered, other than Nike and Lululemon? I mean, come on, these.
Yes.
I want to say that these two stocks are well below their October lows from 2023. And everybody remembers that was kind of like right around the bottom where the S&P 500 bottomed out about 4,100. And we thought we were going to fall off a cliff there, but then we rallied right back. These two stocks have been battered and bruised, and they have no compass going forward, I think. And listen, if McDonald's is having trouble with pricing, and you're talking about $5 meals, some of these other companies like this, what does Nike do with a $200 pair of shoes? Or what does Lululemon do with, I mean, I don't even know how much the leggings cost, $80, $100. I mean, what do they do with that? I mean, if the economy is starting to slow down and the consumer is starting to dial it back, what do they do? Are they going to mark it all down and send it over to Ross and TJ Maxx and mark it down 80%? Who knows?
Well, and that's like, I, for one, first of all, would be very pleased if Lululemon would reduce their prices, just personally speaking. That's a personal story. But no, but you're bringing a really good point too, though, that the high end is also feeling it. So if you're starting to see cracks in the high end, we haven't like got enough information, I think, about the middle yet. But if you're seeing cracks in the high end, the middle's got to be feeling it. LVMH also had a horrible quarter. Part of the story in McDonald's and LVMH and some of these others too is China. That's concerning, right? There's weakness in China and the Chinese consumer. And then also, I think what we're realizing is we've had these rolling recessions. People talking about housing and manufacturing, the auto business, and it's all been okay because of the resilience of the consumer. So this is what we really do need to be concerned about that. So we've got a jobs report coming out on Friday. And it's, there are concerns out there that it could trigger what is called the SOM rule. And it's a rule that was put into place or discovered by economist Claudia Somm. And the gist of that is that it theorizes that we are likely in a recession. If the 3-month moving average of the unemployment rate rises 0.5 percentage point from its low point in the prior 12 months. So if the unemployment rate increases to 4.2% on Friday, which it's not expected to, it's expected to hold steady at 4.1%, this rule would be triggered. And it's predicted every recession since 1970. But she herself has gone into the media and said, I don't know if this is actually necessarily going to play out this time. If it is triggered it this time might be different, Bob. And she says right, famous last words. But I guess it might be different. She says the post-pandemic economy is different. The rise in unemployment is really being driven by more people participating in the labor market, which is a good thing. Not because people are getting laid off. The layoff rate is still very, very low in this country. And I know you have concerns about the July jobs report. Part of it is you hear other economists talk about, Hurricane Beryl in Texas, that's gonna play a role. I don't know. What are your feelings about what we're gonna see out in the jobs market this week?
I think that eventually we have to see job growth slowing down. Right. And we know that there's always this has been somewhat of a consistent 8 to 9 month lag period when it comes to job growth slowing down versus where we're at with the numbers. So, if job growth was starting to slow down about 4 or 5 months ago, it may show up in the August or September numbers, Lindsey. So there's a little bit of a lag period over there, but the trend is certainly in place. And I think what we talked about what you mentioned about the recession is interesting. That I don't think the Fed has been any more worried or concerned about a recession coming up than they are now, right? And I think that the last couple of times we've heard Chair Powell talking, whether it was after a meeting or whether it was at a Q&A, he dismissed a recession and said it was basically off the table a couple of different times. And in the same breath, he would say, well, we do have a chance for a soft, smooth landing, right? And you can't have both of those exist in the same universe, right? At the same time, because one's going to be a crash landing and the other one's going to be a soft landing. Maybe we'll have no landing. Chris has referenced that quite a bit. So I think that the Fed has got their finger on the cut button. If things go a certain way, they will not be hesitant to use that. And there's plenty of room to move. We talked about neutral rate a couple of weeks ago. We're kind of in the same ballpark, 3.25%, maybe 3.5%. That's all they're going to go to. They're not going to go back to zero. Unless something, I'm not going to say never.
Never say never.
I said never after the financial crisis, and sure enough, we had a pandemic and we went right back to zero. So I'm never going to say never again.
You've learned your lesson. That's good.
That's right.
I think for the Fed, I do think the unemployment rate matters because that's the job market they did not care about. We're not even talking about. It was all about what is inflation doing forever, right? For the last several years. And now I think it was the May report in June when the unemployment rate ticked up to 4% for the first time since the pandemic. And that I think turned things. Oh, we have a dual mandate. It's not just prices. It's also It's also the job market. So I think it's going to be something, it is something that the Fed is focused on. Friday's a big day. We'll definitely be keeping our eye on it. I think, I don't know, like for me, the takeaway on the state of the consumer and the job market is that there are signs of cracks, and it's time for us to really keep a closer eye on the job market and on the consumer than we just automatically assumed that they were okay. The situation is definitely changing. And I write a lot about this in my newsletter, The Shift, at lindseybell.com. So, people want to know more about my thoughts about the job market, they should go there. That's my thoughts. I think that's really the takeaway for us on the consumer and jobs.
Well, you just stole my thunder there, because I was going to ask you, what does it all mean? How do we wrap that? But that's okay. We're right there.
Sorry, Bob. I'm sorry.
That's all right. So let's see. Where do we go from there? Where do you want to
Let's go to our economic zone, because we're kind of in it anyway, right? Let's talk about what you and I have dubbed the economic zone. We're going to talk a little macro picture here. Yeah, let's talk about what you thought about the GDP report and where we're going to be in Q3.
Right. So the first look GDP came out on July 25th before the market opened, and it showed a 2.8% growth rate, which was a little bit better than expected. And the number that I look at, not just the headline number there, Lindsey, is the chain deflator. And that really basically tells us how much of that growth was driven by inflation. And it turns out that some of it was driven by inflation, but that number is starting to come down, which is going to please the Fed. I think that depending on what the revisions are all about, and we'll get some more data that will help us determine where that number is. That we have imports, exports number that's going to come out in a couple of weeks. That's going to help refine that GDP number that came out last week. I think that the Fed is looking at this and saying, look, growth is still strong. The labor market is still strong, but we're seeing some cracks, as you said, in the labor market and in the consumer. So we just have to be vigilant. We have to pay attention to what's happening in front of us. And we don't want anything to go awry. But certainly a 2.8% print in the second quarter is pretty impressive when it comes down to it. We had a strong fourth quarter of 2023. Came back a little bit down. I think it was 1.9 in first quarter, 1.8. And we're right back up again. So it's interesting. It's not all AI driven either, which is surprising to a lot of people. But I think that by and large, we're looking at an economy that is still pretty robust, pretty resilient, and I think the Fed is keeping their watch on it.
Yeah, and the Atlanta Fed GDP now, their estimate for Q3 is to hold steady at 2.8%, with the biggest contribution there coming from consumer spending, followed by business investment, and then government spending. And I think business investment, that was another highlight in the second quarter. So you do see companies ramping up their spending on investment. And so these are all good things for the resilience of the economy, the consumer spending there. You just got to wonder, in the PCE report last week, what we did see is wages are up, but spending is up more, and savings is down. The savings rate is down. So again, just like, let's monitor the situation. I've been saying the economy is due for a little bit of a slowdown, given the slowdown in the consumer, but it looks like we're on solid ground here.
And, when you couple that strength in the economy with tax receipts and so forth, and businesses are strong and consumers are if they're paying their share of taxes and so forth, the problem I have is, you have fiscal policy, which has been out of control for 40-something years. And the fiscal problem is not going to disappear. It's not going to go away. We have increasing deficits. How fast is the debt going up $1 trillion a few weeks or something like that, a month, I don't know, some ridiculously fast number that, once it hits a certain level, I think there's going to be people on the bond market who are going to say, you know what, I've had enough. I don't trust the fact that I'm going to get repaid in the same dollars. And certainly if we get another administration, different administration than we have right now, the only thing I see is that I see inflation running rampant, and I see the dollar getting trashed, say, for instance, under a Republican regime, but that's maybe for another day.
On a positive note, I think Chair Powell agrees with you on that. I think he said something to that liking. But I think the positive note on that is that if GDP does continue to come in better than expected, end up like in this mid 2.5% to maybe 3% range, that could be a positive for lowering the debt situation. Hopefully, if we don't continue to spend like drunken sailors. But yeah. So what does it all mean? What does all this economic data mean, Bob? What's the takeaway?
Well, I think it means that the economy is on pretty good footing right now, and even though jobs may be starting to recede, and the opportunities for people to move to another job or to get a new job and get higher wages is going to slow down a little bit. I do think that the economy is still relatively strong, and for so many years, Lindsey, people have counted out the consumer and counted out the public, which is about 70% of the economy. And still, if you do the math, if 70% of the economy is spending by consumers, and we did a 2.8% GDP growth, that's a huge amount. That's 2% of the growth is being driven by the consumer. So, I mean, that's a large amount of spending going on. I mean, I'm sure some of it's all credit card driven, some of it is savings driven, and some of it is wage driven. But still, people are still willing to spend, still willing to go out there. And again, I learned my lesson a long time ago. Never count out the consumer when it seems like they're down and out.
I agree. I always say if the consumer has a job, they're going to continue to spend, which is good for the economy. Why don't we take a quick break before we wrap it all up at the end here? Welcome back to Closing Thoughts on What Does It All Mean? The podcast. Bob Lang and Lindsey Bell here to clear everything up for you. Bob, we talked about a lot of different things today. It was a really good conversation. We started with volatility to the consumer, and we ended with, our take on the macro picture. Is there a takeaway from our conversation that really stood out to you?
Well, I think what's interesting here, Lindsey, is that we're in a transition period right now. And I think the Fed is also in a transition period. I think they're pivoting, but they really don't know it. That's been my call recently, is that they're in a pivot moment, but they don't know it yet, or they haven't actually come out and said it. So I think what are they pivoting from? They're pivoting from a hawkish, tight money policy, and they're making that very, very slow transition into a more dovish, generous monetary policy, which is going to probably last for a long time. It's been about a year since the last rate move. I know the last rate move was a hike in July of 2023, so it's been about a year. So I think that as the Fed sees more data, and as we see more data coming in, and it becomes much more favorable, they're going to slowly turn the crank into where they're positioned to cut rates. Now, I know the market's going to get all excited about it. Of course, earlier this year, you remember that 6-7 rate cuts were on the table. I thought that was kind of ridiculous, and eventually the market said it was ridiculous too, and then we had that big correction in April. But I think by and large, what we learned here today is that the Fed is going to take their time and watch the economy, watch the data, as we all should, which is what they've been saying for months and months and months. So I guess steady as she goes.
I hope steady as she goes. And doesn't always go up, right? We need a volatility in our lives for opportunity. My takeaway is opportunity. That these transitionary periods that I agree to, I think our takeaway is that everything that we talked about shows that we're kind of in wait and see mode. We don't know where we're landing. If you want to talk about soft landing, no landings, I do think hard landing is at this moment off the table. Let's again, steady should go. Hopefully that stays that way. I agree with you that we're just in a transitionary period, which can feel uncomfortable. It's never fun to be in these periods, but that is where real, true investors are made, right? This is where you find the opportunity. You find the courage to sell your high flyers, and you find the courage to buy the stocks that have underperformed for the last 12 months, right? So I do think that the consumer is worth watching, but like I said, they still have jobs. That's a positive. Companies are spending. Corporate debt positions are solid. And I think that even though this earnings season is a really good one, I believe that there could be re-rating downward, which isn't the worst thing in the world for the third quarter and fourth quarter. Still going to be good versus what we've seen over the last couple of years. But I think estimates need to come down. And I think that we're in the process of resetting before what can hopefully be a really good end to the year. So that's my thinking.
I agree with you. And hopefully we'll have some more good stuff to talk about next week, Lindsey, because I know we have that meeting to talk about. We'll talk about the jobs report next week. And it's the start of a new month of August. And I heard somebody has a birthday in the month of August. Is that right?
Yes, because you told me that there are no holidays in the month of August, so it's your least favorite month. And I said, there is one holiday. It's my birthday, August 17th. If anyone wants to send me, I love gummy candy. Okay. But
I've already marked it on my calendar. It's Lindsey Day. And I'm going to, I feel like sending a note into the local newspaper and designating Lindsey Day as a day off for everybody. In fact, you know what? I'll maybe they will, because it is a Saturday this year, right?
Yes, new national holiday. Everybody gets August 17th off. It's a Saturday. Just ignore that part. But
Lindsey.
I love it, Bob. I love it, Bob. Well, I think that wraps it up. It's been a great conversation. I hope we all got you thinking and gave you a little something to chew on over the weekend. And we'll be back next week with another episode of What Does It Mean, the podcast. Until then, you could find Bob, Chris, and I in a couple different places. All of us are on Twitter. Bob's over at explosiveoptions.com or at Aztec99 on Twitter. I'm Giselle Bell on Twitter. Or you can, like I said, you could check out my newsletter, The Shift, at lindseybell.com. And Chris Versace, who isn't here with us today, but is normally here with us, is over at Street Pro Portfolio or Thematic Signals. So we will see you all next week. Thanks, everybody.